Global bond markets get a boost from central bank action this week, and more rate cuts are expected around the world in the weeks ahead. Three emerging market central banks cut rates on Thursday. The Bank of Korea surprised the market and cut the 7-day repo rate by 25 basis points to 1.5%, noting weak exports and trade tensions. Bank Indonesia cut the 7-day reverse repo rate by 25 basis points to 5.75% for the first time in almost 2 years and suggested more room to cut rates. And the South African Reserve Bank cut its interest rates by 25 basis points to 6.5% after slashing its growth forecasts. And New York Fed President John Williams delivered a speech in New York Thursday and stated the central banks should take swift action when faced with adverse economic conditions. While his speech was described as academic and not about potential policy actions by the New York Fed, he made two key points. Firstly, don't keep your powder dry. That is, move more quickly to add stimulus than you might otherwise. And secondly, keep rates lower for longer. He noted he thought neutral policy rate is around 0.5% lower than any time before the Great Recession, noting that systematic issues are driving low inflation currently, that this is a global issue, and he fears further weakness in inflation expectations. His comments encouraged markets to price in a greater chance of a 50 basis point cut on July 31. Now, the ECB meets next week for its last meeting before the summer recess. Back in June at the annual Sintra conference, ECB Governor Draghi noted that in the absence of improvement, additional stimulus will be required. In the same speech, he stated that in the weeks ahead, the Governing Council will deliberate how our instruments can be adapted. With Draghi's term ending in October and IMF Managing Director Christine Lagarde widely seen as continuing his accommodative stance, we could see some further hints on ECB policy actions next week. With the Fed set to cut rates by a likely 25 basis points on July 31, bond markets around the world have reacted well to this news. US 2-year yields again hit 1.75% this week, lows back to November 2017, and the Bloomberg Barclays Global Aggregate Total Return Index is up 5% so far this year. In foreign exchange markets, the US dollar has weakened slightly, but G10 currencies have had mixed reactions. European currencies have tended to lag, with the British pound the weakest currency so far this quarter, as the focus turns to the results of the UK Conservative leadership election, which will be announced Tuesday next week, and press reports suggest that Boris Johnson is looking to hold an early election. On the other hand, the so-called commodity bloc has fared well, with the New Zealand dollar, the Australian dollar and Canadian dollar all showing gains against US dollar so far this quarter. In part, this can be explained by the improving tone in Chinese commodity markets. The record pace of Chinese steel production has been a key factor pushing iron ore prices above $120 per tonne this last week. In terms of domestic events here in Australia, the RBA minutes released Tuesday confirmed that the board is still open to further monetary easing, although, as we had expected, prospects for a third consecutive easing in August have been dampened. Employment data released Thursday revealed a soft update in an otherwise robust trend. Employment rose by a smaller than expected 500, and the unemployment rate rose from 5.19 to 5.24%. While the underemployment rate fell by 0.4 to 8.2%, it is important to highlight that at 5.2%, the unemployment rate is well above the RBA's 4.5% full employment target. This then reinforces Westpac's view that the RBA has further to go in terms of rate cuts if it has any chance of hitting that 4.5% Nauru target anytime soon. The RBA governor may emphasize this point Thursday next week when he delivers his Annika Foundation speech on the topic of inflation targeting and economic welfare. We remain of the view that the Aussie dollar should be capped above 0.7 and expect to see further weakness to 68 cents by the end of the year. Outside of Australia, the ECB meeting will be a key event risk for the week ahead, as will the naming of the new UK Prime Minister, who'll move into number 10 Downing Street on Wednesday as Theresa May vacates the premises. Robert Mueller is due to testify before the House panels on Wednesday, and we're also due to receive the advance print for Q2 GDP Friday next week, where forecasts have the slowest pace of growth in the US since 2016. These are all factors we'll talk about in next week's Markets Update.